Overnight, stocks got wiped out. Billions of dollars gone. And the reason had a strange name: push-button liquidity. Sounds like something out of a sci-fi movie, right? But it's real, and it's happening right now in July 2026 in the US stock market. Today, we're breaking down three things. What actually happened in the market? What is a margin call really? And most importantly, is the market actually about to rebound, like top Wall Street forecasters are saying? If you're into investing, or you just want to understand how markets crash and how they bounce back, this video is for you. Let's get into it. Let's start with the basics of what went down. In recent weeks, the US stock market saw a sharp, sudden drop. Stocks that had been steadily climbing suddenly started falling, and this wasn't normal selling. It was a chain reaction that investors are now calling a margin call cascade. What triggered this cascade was something called push-button liquidity. In plain terms, large institutional investors and hedge funds use automated trading systems to manage their positions. When the market dips even slightly, these systems automatically start selling to limit losses. Here's the problem. When one system sells, prices drop further. And when prices drop further, another system gets triggered too. It becomes a domino effect, a chain reaction that shakes the entire market within minutes. Let's break down the term, because it confuses a lot of people. When an investor buys stocks on margin, it means they're investing not just with their own money, but also with money borrowed from their broker. This is leverage, a way to buy more stock with less of your own cash. Now, if the stock price falls, the value of that investor's portfolio falls too. And if the value drops below a certain threshold, the broker sends a margin call basically saying, either put in more money or we're going to force sell your stocks. That's exactly what happened in July 2026. When the market dipped a bit, a lot of leveraged investors got hit with margin calls. And when everyone sold their stocks at once to cover those calls, the market fell even faster. This is called a forced liquidation spiral. The hardest hit sectors in this crash were tech and AI-heavy stocks, since that's where the most leveraged positions were concentrated. But here's the interesting part. During this same period, some sectors actually performed really well. The banking sector, names like JPMorgan and Bank of America, beat expectations in their Q2 earnings because higher interest rates actually work in their favor. So this isn't just an everything crashed story. It's a rotation story. Money is moving out of one place and into another. Now for the big question, will the market bounce back? Top Wall Street forecasters are saying yes, the market is poised for a rebound. Their logic is simple. When a market falls because of forced liquidation, not because of genuinely bad news, the recovery is usually quick. That's because the company's actual earnings, growth, and business models haven't changed. It was mostly short-term panic selling. Even Warren Buffett recently commented that it's tough to find values in the market right now, meaning prices are already pretty stretched, but that doesn't necessarily mean a crash is coming. On the other hand, there are cautious voices too. Inflation is still running above the Fed's target, and if the Fed keeps rates elevated for longer, the recovery might not be as fast as some people are hoping. So the real question is, if you're a regular investor, how does this affect you? First, if you don't use leverage or margin, you probably don't need to panic. The core cause of this crash was leverage itself. If you're investing with your own money, this is mostly just a period of volatility, not a structural problem. Second, events like this are a good reminder of why diversification matters. When one sector, like tech, gets overly leveraged, the risk in that sector goes up too. Banking and energy stocks showed a lot more stability during this period. Third, if you're a long-term investor, history shows that after sharp, liquidity-driven crashes like this, recoveries tend to be strong. That said, there's no guarantee, and everyone should make decisions based on their own risk tolerance. So that's today's breakdown: how a push-button liquidity event shook the market, how margin calls actually work, and why top Wall Street forecasters are still optimistic about a rebound. If you found this video helpful, hit like, and don't forget to subscribe, because every week we break down trending finance topics in simple terms. Let me know in the comments, do you think the market's going to rebound or fall further from here? See you in the next video. Asterisk. This is educational content, not financial advice. Please consult a financial advisor before making any investment decisions. Asterisk.